So, welcome to today's podcast. I'm super excited today. I love doing these podcasts because I get to share wisdom and expertise and knowledge from so many people. And I'm really excited about today's guest. A friend of mine, he's a fellow infinite banking practitioner, and he's got way too many credentials to share with you. He's an enrolled agent, he's a certified financial planner. But I have Joe DeFazio with me today. He's the founder and principal at 10th Street Capital. And I'm really excited for him to come share his sort of background and some wisdom around taxes and financial concepts. So, Joe, thanks for joining me today.
Tom, it is a pleasure to be here. Yeah, I'm really excited to talk about our topic today. Thank you for having me, first and foremost. But yeah, let's get to it. What do we want
Let's
to
get
talk about
to it.
today?
Yeah, let's get to it. Listen, and this is why every time I talk to Joe, I learn something new. So I know you're going to get tremendous value. And Joe being an enrolled agent in this time of year, right? Taxes are at the time of recording, taxes are in full swing. It's bright and sunny spring, but we got to deal with our tax situation, which is for successful people like you, can be the biggest expense you're going to face in life, right? If you're successful and the government wants their share of it, they're going to try to do that where they can. So this is a attempt to just share some thoughts around the tax code and certainly how it fits into the infinite banking concept, but we'll get into that in a minute. So Joe, just share for our listeners, can you share a little bit about your background too? Just a quick little snippet, and you've had a very interesting sort of journey through your life in the financial services space, and love for you to share.
Yeah, sure. So probably I started 10th Street Capital as a full service financial consulting firm, offering services in fee-based financial planning, portfolio and investment management, insurance services, and of course, as you alluded to, taxes. Before that, I was with Northwestern Mutual for several years, a decade almost, give or take. Within their system, I worked as an agent, just selling life insurance, a financial planner. I worked to support other advisors, financial advisors and financial planners. I worked in the local offices and in a larger district office. And then eventually I was working with several more successful, larger advisors. And that's kind of where I ended things, and things came to a head, and I decided that I kind of wanted to build something my own way. And throughout the years, I had, as Tom alluded to, I earned several credentials: CFP mark, the enrolled agent mark, the CHFC, CLU, CAP, RICP, WMC, ABCDEFG. I guess they call it alphabet soup. I was just trying to learn more and more, and I think what those credentials did provide me was context. Above and beyond anything else was just being aware of different scenarios and how to handle them, and a tax sensitive concept to bring to market. And one day I was running down 10th Street in Philadelphia, close to my house, and I just was like, you know what, I'm not getting any younger. So I've played several roles within the industry and within large organizations. So why not give this a shot and build something from the ground up? A way that's focused on tax sensitive planning, that I'm allowed to say I'm giving tax advice, that I'm allowed to say certain things you're not allowed to in those larger corporations. So yeah, that was and then 10th Street Capital was born. So that was it.
That's
And
awesome. That's
yeah, I've been excited every day. I love what I'm doing. And I mean, like anything, it's slow to get up to speed, but you're doing it with your own blood, sweat, and tears. You're building it your way, and the idea is a huge legacy. So I'm pumped. So
That's awesome. No, I love it, and I love your sort of desire to just continually learn more. And I think that's something everyone should adopt. We have this one life to live, however long it is, and that's why you're here listening to here to learn more, right? So, taxes not a topic that everyone loves to talk about. I actually do enjoy talking about it. It's fascinating. And so, Joe, let me ask you, because I know you're a historian on a lot of things, and can you share a little bit sort of the history of the tax code, right? It's evolved quite a bit, but it's been around for a while, but it wasn't around forever. But like, so tell us a little bit about sort of the background of how the tax code started and how it's evolved.
yeah, sure. So the current form was put in place in 1913. in the same year, the 16th Amendment, in the same year, the Federal Reserve, and in the same year, the 1040 was all born. Prior to that, the country, the United States of America, funded most of its initiatives with like tariffs and temporary taxes. So personal income tax came and went many times. Like there was a lot of fighting in Congress over this. It was repealed several times. And then in 1913, for better or worse, we're stuck with personal income taxes. But I, one thing to kind of take note of is since 1913, if you were to go back in time and look up the original 1040 and look at the tax brackets and look at the deductions and so on and so forth and compare that to today. Now you have to do a little bit of calculating because you got to adjust for the dollar value over time. But if we did that and just said, if we kept that 1040 the same as today, the standard deduction would be something like $120,000 instead of, depending on what you're claiming at, under $30,000. And you would not pay the first bracket, you would not be in the first bracket until $620,000 if you earned $620,000. So most people would pay 1% on anything over $120,000. That's 1% of your tax. That would be your tax bill for the federal, like, whew. But that's a far cry from what we have today. And I guess the theme is if you take a long enough view, you can see the tax code gets ever more aggressive. Like they introduce something and then they turn up the heat slowly and steadily over the years, and it applies to more and more people. Another good example might be Social Security. When that was put in place, it was actually tax free. The benefit that you received was tax free. Then, somewhere along the line in 1984, they decided 50% of the benefit should be taxable. That's not 50% tax rate. I just mean 50% of the benefit you receive now is included as tax in your taxable income. And then, I don't know, maybe a decade later, 1993-ish, they decided, no, we're going to turn that up to 85% is going to be taxable. 85% of your benefit, that is. So it just, once they introduce something, the propensity is to continuously make it more taxable. So just keep that in mind as we discuss some of the tax benefits today. That luckily, what we're going to discuss, the product we're going to discuss, and the process we discuss are not part of the tax code. They were not originated out of the tax code. It was free market, private contracts that created this, which is working to our benefit. Thank goodness.
Absolutely. It is quite amazing because people forget that tax code was supposed to be temporary, right? I think in a lot of ways, right now we're here over 100 plus years later, and it's gotten to a point that there are very few people who truly understand it in its entirety. It's gotten so complicated. And if you ask any, I sometimes ask other CPAs or tax professionals, enrolled agents too, where do they think tax rates are going? Well, there isn't anyone who tells me it's going down or getting less complex. It's getting worse and more complicated over time. So that's why good to have people like you to help share some wisdom around it.
Just something to remember, like you asked about the rates. Just as you're asking about taxes, just realize there's a lot more than rates involved. If anyone's only focused on your marginal rate, that's an incomplete way to assess what's going on in your taxes. For example, the government can obviously increase your rates. Yes, that is one way they can increase tax revenue to the government. They could shrink the tax brackets. That doesn't in fact impact the rates, but it will increase your taxes. They can reduce, they can eliminate or limit deductions or credits. Those both will increase your taxes. They can invent new taxes, like just going back to a little bit of history, we were all alive for this one. When the Affordable Care Act or Obamacare was introduced, they introduced additional Medicare, which was also Obamacare tax that just came out like they just invented it. So they can create new taxes and they can tax things that weren't previously taxed. So don't, it's a way oversimplification to just say, hey, what was your marginal tax rate? What do you think it will be in the future? Okay, that was the analysis we needed to do. That tells us what to do. You have to think a little bit deeper than that and look at some other potential trends. But yeah, sorry, I just wanted to that's a great point. Like just the rates is not enough. You got it's growing in complexity and all what I just said is added like how it's growing in complexity. Just you got to pay attention to that.
Absolutely. Yeah. And it's one of those things is like I said earlier, if especially if you're growing in success in your life, your business, your job, whatever situation, this is just getting become a much more onerous sort of burden on people. And I think it just strips away a lot of freedoms we have to do things that we really want to do. So this is the reason why we focus so heavily on it. So now I'm going to shift gears, and this is the core aspect I want to chat about today and get sort of your sort of take on, Joe, is the sort of tax sort of perspective around the infinite banking concept. And this is something that we both are practitioners. We feel it's a tremendous sort of process and approach on how to manage our cash, right? Our cash storage and flow and management of that. This is the best process, right? And strategy to do it. And there's a lot of tools that could be applied or leveraged for this, but we have found that specially designed whole life insurance policies do it the best and has a lot more sort of. So before we get into that, Joe, we're not going to go deep into it here, but at its kind of core, like IBC, right? Infinite banking, sort of, what is it from your lens, and sort of what is sort of the reasons why life insurance or whole life insurance could be is in our eyes the best sort of tool to use with it.
Yes, absolutely. So infinite banking concept is a trademark term Nelson Nash put in place years ago. I believe it was years ago. I don't remember when he filed the trademark, but it's a really important to separate life insurance from this term. He trademarked this term to describe a process. You have to understand that first. And he, like, if you haven't read his book, I'm sure Tom has linked it several times, Becoming Your Own Banker. Please read that book because he gives several examples in the book where he compares using other instruments, other financial products, other ways of implementing this process that you can do. They're just inferior. And if you had the choice, why would you choose the inferior option? But just it's really important to separate the two. IBC, there's no such thing as IBC life insurance. It's like Tom said, I have several credentials. It's not on any exam I've ever taken. None of them. There is no IBC life insurance. You can use IB life insurance to implement the infinite banking concept. From a tax perspective, what I love about combining those two, life insurance, like you don't even report life insurance on your taxes. I shouldn't say that. There are very there's a minute chance that you would report life insurance on your taxes. But by and large, there's no 1099 each year. There's no reporting requirements. It doesn't show up on any of the standard forms in standard practice, which is makes a tax preparer's life and an accountant's life so easy. There's no worry there. And the implication of that is, which we're going to dive into, there's certain aspects of this that are outside the purview of the IRS, which is very beneficial if you're not paying these increasingly aggressive and onerous taxes year in and year out. It allows your wealth to grow uninterrupted. And yes, so IBC, different than the product of whole life, but if you compare everything, I mean, 401ks, you can compare checking accounts and CDs, and you can compare several products. You can go down a list. If you are clear with your classification on what you're looking for, you'll find dividend paying, whole life, permanent insurance from a mutual company is the best product to use.
Absolutely. So we'll go into it because, and we've always joked to say whole life is meant to be used your entire life. And so we're going to kind of cut it into to kind of four sort of buckets and go through it. And Joe, share your thoughts on it. So obviously, when we're starting off, whatever age that you started at, we are putting money into it. We're contributing capital to our policies and our asset here, and obviously we call it here family bank and infant bank. And so let's start with there. So what does that look like as you're contributing and building up your cash in these types of assets.
I think when you're deciding to implement the process and you've come to the conclusion whole life is the right product to implement the process. So you've gone through probably some type of medical and application and gotten this contract, this private contract in force. From there, you are paying with after tax dollars, right? You pay a premium to a life insurance company, and that life insurance company then will guarantee the terms of the contract. So the terms of the contract are pretty simple, but they're going to become more important as we talk more. They're going to give you a death benefit, and there's a secondary benefit, an endowment benefit at 121. So the endowment benefit would be if you live to age 121, they will pay you out the value of the contract, which is the aggregate death benefit. So it's unlikely, but that's why the death benefit's in place. So the death benefit says if you die before that age 121, they'll pay your beneficiaries the death benefit. So over time, as you're paying your premium during these years, these working years, it's like each year they will appraise your contract, your whole life contract, and say, how much is it worth this year? Like that value is called your cash value. I like to call it cash equivalent value. Please don't consider it cash. It's like this is the value the insurance company will say, we'll pay you this if you relieve us of the obligation of the death benefit and the endowment benefit to walk away from the contract, essentially terminate the contract. But it's after tax dollars going in that accrual or the increasing cash value is also, as we hinted earlier, tax deferred, meaning there is no taxes on the increase each year, which is a huge benefit.
And for the cash value too, is it the other aspect of it is it's guaranteed, correct? At least a portion of it per the contract, right? There's a
Yes,
guaranteed cash value that's built up each year. Can you talk more about that and sort of how that might change over time?
yeah, huge point here. The cash value is not invested in a mutual fund. It is not invested in a side account or sub account. It's not. It's the value of the contract today. And that value is contractually obligated to increase. It's not like earning interest. It's contractually obligated where the endowment is when the cash value meets the death benefit.
Mhm.
Okay, so that has to happen. If you read your contract, there's a date, depending on which country you're in, whether it's Canada or America, it's like 121. They're going to say, hey, that's when the endowment happens where you can say, send me the money. Now, that actually is a taxable event. If you live to 125 and you have received that money at 121, that's a taxable event. It's really important that it's not invested in something. It's not in treasuries, it's not in bonds, it's not in the general account. It's a contractual increasing value of your contract.
So with that too, the cash can grow more because there's also optional dividends as a mutual insurance holder. And those are not guaranteed, however, but if you take them as buying additional insurance, that also increases your floor, right, in terms of what the cash value is. And that also grows tax free, right? There's no tax implications of that. Is that correct?
Yeah, that's a great point. Let me take a sidestep here. So we did not increase, I'm sorry, we assumed the death benefit was not increasing when I said this, right? So the cash value is chasing the original death benefit. It's like now dividends are classified by the IRS as a return of premium.
Hmm.
And I can kind of give you an interesting way to think about that, but it's essentially the insurance company has determined that you paid too much premium for the death benefit in any given year. So to reconcile their books, they say we have to give this back in some way, shape, or form. Right now, it's still premium. So you can apply the premium and buy a single premium, permanent increase in death benefit for the rest of your life. That will be part of your policy. Or you can use that premium to pay next year's premium, like work towards paying the next year's premium. So you're reducing what you have to pay out of pocket. Or they can give it back to you in cash, right? That's they can convert the premium back to cash and give it to you. When you do that, there could be tax implications. But because you paid after tax dollars in as premium to the insurance company, it remains that after tax dollars. So the premium is not taxed. That's why this reconciliation is tax free. So, quote unquote tax free. But the dividends will increase the death benefit. Well, we know the contractual relationship is over time, the cash value has to equal the death benefit. So as dividends increase the death benefit, the cash value has to grow accordingly so they still meet at 120. That's contractually obligated. So it's not guaranteed. As they're paid, the paid dividend, once it's credited, is guaranteed. It's part of the contract now. It's essentially guaranteed from that point forward once it's credited to your account. They can't go back and say, we have to take those off your policy. Once it's in, once it's paid and accredited and your death benefit increases and the cash value increases accordingly to their ratio, it's locked in permanently for the rest of your life. I think that's one of the understated benefits of using whole life from a mutual company that really supercharges this concept above and beyond some of the other options you have. Like when your dividends are increasing your death benefit and your cash value is then increasing, it means you're going to have the ability to collateralize that, which we'll talk about in a minute. You'll be able to collateralize more than what you've paid in. And your collateral is guaranteed to increase. And meaning it cannot go down. There can't be a margin call. There can't like it's an incredibly powerful combination when you're able to collateralize something from a company that is also guaranteeing a guaranteed increase in the collateral. It's like this, it's a little bit circular, but once you get past this point where they say when water turns to steam or when needles are alive, when a plane's about to take off, it's like once you get past this one point, the cash value equals more than what you've paid into the policy. Um, Now, depending on how you arrange the structure of the policy, you can you can make that happen a little earlier or a little later with certain trade-offs. There's certain significant trade-offs if you do it too early. But point being, all of them have a point where needles are alive and what you've paid in premium is less than the cash value that's available, and it increases each year. So you can collateralize freely that increase each year, accessing it during these years in the first phase of your life. So it's like you got to listen to that a couple times.
Your assets is
Oh,
in a lot of ways your asset is growing, right? And we have to contend with inflation, and so this is an asset that to Joe, to your point, like to Joe's point, this asset is growing, the death benefit's growing, and the cash value continues to chase this death benefit that's also growing, right? So to that point, there's going to be a point, especially depending on how you design it, it could be sooner, that your cash value is going to exceed what you put into this policy, and it's going to get even more efficient as time wears on. So this is a very long-term sort of approach, and sort of you'll start seeing it gets into like a steadier mode here, that every dollar you put into it's growing by more, right? And we can do that in an accelerated manner depending on the design of the policies. So let's shift gears here a little bit, because you talked about already the how we use this growing cash value throughout life, right? Because we have to finance things, purchases, investments, and so this is a way that we can leverage these dollars that are growing in here for financing needs. So talk a little bit more about that. What's the sort of how that happens and what's the tax implication of trying to use these dollars in that fashion?
Yeah, if we go back to IBC first, the concept, we're not talking about whole life. The concept is being able to collateralize an asset so that you can recoup the lost opportunity cost. So your asset can continue growing, but we're collateralizing it to do something else. And by doing that, instead of just going to a bank and getting a loan where the bank is the one reaping all the benefits in that relationship, this way, depending on the asset, you can recoup more and more of that lost opportunity, which, given enough time, that will create a massive tailwind for your financial future. So loans, thankfully, are not taxable. So when you go get a mortgage, forget IBC for 1 second. Let's put a pin in that for 1 second. If you go and try and buy your first house or fifth house and get a mortgage, that you're not paying taxes on the mortgage that you've taken out, which is a huge benefit. If you understand that, even if you have a credit card, if you go and buy a sandwich, you're not paying taxes for them advancing you the money, right? So that's really important. So if we can harness the power of accessing our capital through loans instead of withdrawals, because withdrawals tend to be more taxable. There's usually a crossover point where cost basis, the value exceeds cost basis, and then there's gains and taxes and so on and so forth. But if you can leverage it using collateral and a loan mechanism, there's no tax implication for using those dollars, which is a massive benefit. It allows something like we talked about, IBC, we're using whole life as the product to implement IBC. That contract, the private contract, is increasing. So the collateral is getting better and better, higher and higher quality. So then we can go back to not the bank, which banks will accept this. You could use your whole life insurance as collateral with a bank. That's not the ideal way to do this. There's built into the contract is a inherent provision where you can go directly to the insurance company and say, how much access can you give me of my cash value? Normally it's somewhere in the 90, maybe 95%, depending on your policy. They will advance you 95% of your cash value. You can use that however you see fit. So for example, let's go back to real estate. If you wanted to buy a vacation home in, I don't know, Mexico or British Virgin Islands or something to that effect, or Peru, I was like, there's no extra reporting. You just say, hey, I need $250,000. So long as you have that much accessibility, they will just strike the check. What bank account do you want it in is going to be the question. Do you want it in check or wired to you? So that's the question you have to answer, not where are your W-2s, what's the last 5 years of tax returns, and sign these crazy addendums, and what are you going to use it for? And we need to see your checking account history for the last X number. There's none of that. There's none of that. I think it's called Mickey Mouse paperwork. But the ability to collateralize this with a built-in loan provision with the life insurance company that is guaranteeing the increasing capital, it's it's an incredibly powerful concept. In some circles, they'll say, "Hey, we're going to compare life insurance by I don't know, what's it? Buy term and invest the difference." So something to that effect. We're going to compare your permanent life insurance to buy term, invest the difference. When in reality, you're ignoring the idea that you're you're buying term and investing the difference. You're negating the fact that the permanent life insurance can be re-advanced, right? Your investment portfolio is subject to the whims of the market. We have a 90% correction. It's like, that's not going to look great. But if you had an asset that did not dip, that you can access 95% of the value and then buy at the low, or somewhere near the low and watch the portfolio recoup 1,000x. I don't know. It gives you far more flexibility.
Absolutely.
Um,
And to your point, whether it's a house or a stock portfolio, whatever asset you're trying to potentially leverage, this is an asset that does not go down in value, right? It will not be impacted by any market or gyrations. So you have a stable product and doesn't come with all the headaches of trying to go borrow against this, right? So, and then you have the freedom to pay it back on your terms. So this is where the flexibility and sort of freedom it gives people to be able to use their dollars all through life. I don't have to wait till 59 and a half to use it. I can use it now whenever opportunities present themselves, right? And most people I come across, their money's stuck in their homes or their qualified plans, and they're not able to access their dollars easily. This gives you that freedom to do that, to invest in, like you said, real estate or your business or whatever comes your way, right? An opportunity. So it's an absolutely powerful tool that, once understood, can help explode your wealth over time, right? If you understand how to use it. Absolutely powerful.
yeah,
So,
like, oh, sorry, go ahead, go ahead. You're right. I was just gonna say, like, just piggybacking off that concept, like, patient capital attracts high quality opportunities. Like, the quality of your capital attracts a mirror image quality in opportunities. So the first thing you have to understand is not everything called an opportunity is an opportunity. So it requires discernment, right? You have to be able to distinguish the wheat from the chaff. You have to be able to say, what's actually worth my time, energy, and capital? But if you have something like this concept using whole life insurance specifically, the quality and the accessibility, the built-in provisions of this contract can be harnessed and so powerful to capture opportunities, high quality opportunities. To your point, there's no limit. You could use it for business. You could use it technically, you could use it for a vacation if you wanted to. You could take the family on a big family vacation. It doesn't have to be RO
right.
engineered for the highest. You could just have a peaceful vacation that instead of someone else telling you this needs to be paid off in 6 months, you're like, you know what? I'm going to pay this off in 18 months and give myself a payment holiday around December of each year because I don't feel like paying when I'm paying for, gifts for people and things like that. You have so much control because just how high of quality this collateral is, the contract is. If, caveat, if you're working with the insurance company. Now, if you were to use this and say, hey, I'm going to go to a bank to collateralize it, the bank still has control of the terms. So they will put you under that regime of you've got to pay it back in 6 months. More and more, as I study it, it's more about control. It's so much about control and opportunity cost. Oh my goodness. If you can wrap your mind around those couple ideas, there's I haven't found anything that offers you this much flexibility. And it's not, yeah, it's not in the way of anything you want to do. It's just the foundation where you can build off of to do any of the other things, any of the other investment, any of the other life major purchases that you want to do from here. I haven't found a more efficient way to do it.
Incredible. So, with that in mind too, this is kind of the stage where people are building up their policies and so contributing to it. And then, so what most people are trying to plan for financially is someday I get to retire, right? Whatever that means. I'm not a big proponent of the concept of it, that we're put on this earth to kind of serve somehow. So I'm going to continue to do that for as long as I'm able to. But some people want to shift into maybe downshift their lives a little bit, maybe change careers or quote unquote retire. How
Yeah,
can this asset be used as help supplement that in terms of income down the road?
sure. Well, I want to break this up into two answers, if you're all right with that. Actually, three, we'll say. So the first, we'll say the more traditional view would be the death benefit. to the surviving spouse allows you more freedom to take income from other assets, right? So that means your IRAs or your 401ks, your retirement plans, your Roths, like you can spend those assets down more freely, knowing you've got like an instant refill
Mm.
of the bucket for your surviving spouse. So there's a degree of um, freedom there. There's a degree of like peace, knowing that we can do whatever we want because we have this backstop, this refill reset button. That's one. Two, I think specifically using whole life in the IBC capacity throughout your working years means every premium dollar you've paid in and every interest payment you've made on any of the loans you've taken counts as your cost basis. So what that means is when you get to a point where you want to take money out of the policy and your plan is to not repay it, you get to access that cost basis tax free, just like any other asset. So there are a couple ways to do that. You could say from here on out, insurance company, please send me any dividends I'm entitled to in cash. They will do that up to your cost basis tax free. No reporting. Beautiful thing. It can be looked at as a slightly variable income stream, right? Each year, you don't know how large it'll be. It's likely it'll stay right around the same number each year. The actuaries tend to over-engineer these products. That's why the dividends can be so consistent. And then the third way might be you're going to say, remember the dividend buys a paid up addition or a permanent increase in your death benefit each year that you have one. Well, those you're allowed to trade those in and say, hey, I'd like some income. I'll give you back some of the death benefit if you return some of the income. It's up to your cost basis. That's surrendering your paid up addition. And they will do that too. That's far more consistent. You can peg that to say, hey, I want $50,000 per year. And they will surrender the right amount of death benefit per year to give you that money. So you can see that this can create, so it's all a ratio. If you pay $1 of premium, you can't expect to withdraw or take dividends or surrender additions of $1 million a year in retirement. That's just silly. But if you were using this in the capacity that IBC suggests you should to finance things throughout your life, there's no reason you couldn't expect somewhere in the neighborhood of 50, 60, 70 for the average American to be able to pull off of this policy. And not the key. And if you're working with an IBC practitioner, they're going to design it such that it's not going to deplete your death benefit, right? So for until you're 85, you can pull a similar amount of income off of this policy, and your death benefit remains roughly consistent the whole time. So it's
Okay.
not destroying that backstop when you're spending other assets as well. So there's a couple ways you can access uh, income from this policy.
So with that said, I mean, you're building up over time, it's growing, it's becoming even more efficient as time wears on. And the time you want to maybe start extracting everything you put into it, there's different ways to do it through dividends or to your point, with surrendering some paid up additions, et cetera, that you could take everything you've contributed to this policy tax free first. And then if you really want to start touching the gain, what do you do at that point?
Well, we kind of already hit on that. If you, instead of taking dividends in cash or surrendering additions that because you don't have any more basis, the insurance company will notify you and say, hey, we need to confirm your social security is correct because we're going to start sending you 1099s each year that you're going to have to report as income. Instead, you could say, okay, let's stop that. I'd like to take loans instead. Remember, loans are not taxable, at least under the current tax code. So you can then collateralize again that 50,000 or $100,000, whatever you're trying to access each year. And again, it goes back. Now, there will be an interest that accrues over time, but you can use the dividends to pay that interest. You've got some interesting options within the contract. You could say, I don't want to pay any more premiums, which is not advisable. As long as you possibly can, you want to pay premiums. We can explain that a little bit later, but there's a relationship to the increasing cash value and the increasing death benefit and the increasing dividends as long as you're paying premiums. So that's like last resort, absolute last resort. But it's an option. You could
Yeah.
say, I don't want to pay. I decided, I weighed the pros and cons. I don't want to pay any more premium and have the dividends pay the interest on the loan. So that's not really accumulating against me anymore, and just send me the maximum it can. And it will be tax free as long as the policy can support it. And I say that because I referenced it earlier. Depending on how you design the policy and how much you're trying to take out of the policy during income time or retirement years, if you don't have enough permanent insurance from the original contract, or called base insurance, you may not be able to support as much later in life. So you have to weigh the pro and con of a little bit early access versus less liquidity versus, do I want to be guaranteed to be able to pay more, receive more in dividends and income and PUA from the policy later in life,
Yeah.
because that's going to be related to how much base insurance you've purchased.
Well, this is why you work with someone who's trained on these sort of things and understands it and works directly with you, like Joe or myself and another IBC practitioner, because these are all sort of complications that could happen down the road. But suffice to say that you can utilize this asset obviously through life, and certainly as you're building your wealth to when you maybe taking it as income tax free, and we can make that all tax free if done properly, right? So the other angle, and you mentioned earlier in the discussion, what happens with your beneficiaries, your spouse or your children, and sort of estate planning. Sort of the whole life insurance is a absolutely powerful tool to help with that. So obviously, one of the pieces is that the death benefit is income tax free, right? Because that's just the nature of it. It's basically like any insurance, it's how it should work, right? It's a loss that you're replacing. And whether you lost a house or something and then replace it, that money is not taxable income to you. For others, if you've expanded your estate taxes, and that's always changing too, that could have some implications. So, Joe, can you talk a little bit about the sort of tax end of it for related to sort of when you pass and kind of in addition to what I just shared there?
Yeah, absolutely. Disposition of your assets, like if you compare this to something like an IRA or retirement plan, um, this is income tax free. It's not estate tax free, um, but it is income tax free. So when you pass and this goes to a spouse, they receive that beneficiary as a beneficiary. They receive the benefit tax free, income tax free. That is also true for retirement plans. So, like if you had an IRA and it went to your spouse, that's not a taxable event. The spouse is able to just treat that as if it's their own. They have a couple choices, but more than likely they're going to treat it as it's their own IRA. So, in that sense, it's not unique there, but what is unique about it is it's cash in your account. And from that point, they get to choose what they want to do for the whole amount. And there's no tax implication. Like it's 100% basis. It's as if it was in your savings account. It's net, right? So they get to decide what they want to do with that moving forward. An IRA, on the other hand, all the regulations and compliance nightmare and the taxes, the baton just passed to you.
Mm-hmm.
So when you pull that money out as even as the surviving spouse, now it's income tax, and that income tax may make your Social Security tax and your IRMA tax for your Medicare. Like the taxes just layer on top of each other. If you had a choice to receive $1 million in an IRA or $1 million that was already taxed, tax free in cash, most people are going to say, well, I don't want all those regulations and all the rules, and depending on who you are, when they get to tell you when you take money out of it, and I'd rather just have the cash. My goodness, is that simple. And honestly, we're probably going to go, the next stage is a branch off of this one, which what happens when I die as the surviving spouse to my beneficiaries. So like the final stage of the assets might be the liquidation stage. Like for an IRA, if I received an IRA and I didn't use it all, and then it went to children, they have a few years that they have to pull the entire amount out.
Hmm.
Most likely, they're going to be in their peak earning years. So the tax rate they're going to pay on top of their normal tax, I'm sorry, the taxes they're going to pay on top of their normal taxes because they have to take this money out. Very complicated, probably annoying, probably unnecessary because they probably don't need it. Whereas if the spouse has a life insurance policy, it goes to me, and I have a life insurance policy, then whatever's left plus my death benefit goes to, like, it's all tax free. Yeah, it's far easier
Right.
to work with. It's, um,
And on the state tax side, for in some states have, we're not going to go deep into this, but like, right, there's some states that have inheritance taxes regardless of threshold. And so there's a lot of complications to it, but suffice to say, for people who maybe are facing estate tax sort of impacts to their wealth that they transfer, there's also the option to do irrevocable trust, right? There's other options that can shield wealth through the death benefit so that you pay no estate taxes or inheritance taxes, right? So there's extra planning that comes along with that. But if you are of that wealth, there's still options here, and they still treat this as a asset that can be passed on without being part of your estate.
yeah, yeah. So I'm in Pennsylvania. We do have an inheritance. Depending on your relationship with the decedent, it can be 4, it can be 15%, depending. That's just state level, not, and depending on where you are locally, there might be some other tax. There's also federal. Like if you have, we're talking millions upon millions of dollars, but if you have that type of estate, yeah, they're going to get hit with a double digit tax there, percentage tax, 40%. And honestly, we can't really peg the numbers because in a couple years, the current form of the taxes or the current modification to the tax code is being sunset, meaning it's going to revert, but there'll be new rules introduced. So, like to
Well,
say, yeah, it's we're going back to that, it's really complex. And every year it changes. So, but your strategy here where people will take life insurance and have it owned by a trust is outside of your estate if it's irrevocable. So that means even if I have $100 million in my estate, if I buy life insurance outside of my estate, that's not counted when you're figuring out my estate taxes. So it's the one caveat there is depending on how you set up the trust now, you've lost access to the cash value. Doesn't have to be. There are other provisions you can add to the trust to allow a spouse access to the cash value. But yeah, once if you're implementing this and you're entrepreneurial and you have multiple businesses, there's no reason why you can't assume that your estate's going to be a very large estate, meaning you're going to have to implement some of these strategies. The most efficient way to transfer assets is so far undefeated life insurance. So it's probably going to be part of your equation, but you don't want to, I don't want to bifurcate here and just say, hey, we're using this throughout our life and then it's gone. It's in a, not gone, but I mean, we need something in an irrevocable trust over here. We need to maintain access to it. So make sure you're working with the right professional that can work with the right attorney to draft the right type of trust so you can maintain that flexibility that got you this huge estate in the first place.
yeah, That's the thing. This is why you get the experts involved with things like this. But even if you aren't of that wealth at this stage or down the road, it's still going to provide some tax benefits as you transfer wealth over, right? You may not even need these sort of trusts in place, but for just a normal person, that the income tax treatment of it is still solid. And for most people, it will pass estate tax free too, right? For many people. So huge advantage in that. So hey Joe, we're coming up with the hour here. We've talked through a ton of different things and really appreciate all your sort of insights and wisdom around this. But in a nutshell, what we've covered here is that all through life that the use of this asset that predates the tax code, right? This sort of asset, right, has so many advantages related to the tax code itself and how we can use it and help us build our wealth and even transfer it. It is an amazing tool. And but as we know with the tax code, it could change in the future, right? Because people are everything is always changing. So the last thing I'd like to maybe just get your thoughts on people who may be getting into this or now learning it, like have they tried to sort of change the rules around this? And what does that mean for us going forward potentially?
So they have. They almost every year, I feel like they've tried to change the tax treatment of cash value, the increasing of cash value. They've looked at taxing loans such that if you have a loan outstanding, like in Canada, for example, if you have a loan outstanding at the end of the year, they're going to treat that as income.
Mm,
So you're going to owe tax on it. Now, I believe when you pay the loan back, you then get a deduction. But it just goes going back to what I originally said, the tax code starts out small and simple, or it seems that way, and it just grows in complexity and it grows aggressively. So to suggest that life insurance will never ever be subject to any different tax treatment, I no one knows that. The likelihood is they're going to attack it, and they will attack it for years to come. The point of it, in my opinion, if I was new looking at this, the benefits are found in the control aspect of it and the opportunity cost. If you can wrap your mind around that, the rest of everything else we're talking about is details. It's just, it's fleeting because if they're attacking life insurance, trust me, they're already attacking, for example, Roth assets. I believe President Biden wanted to limit Roth conversions or completely eliminate them because they did a study that said only people making over X amount of money were doing them. It's like, why that's fair, I don't know. But it's anybody's view on who they want to favor within the America. They can attack anything. They can attack Roth, which they invented, Roth assets. They invented traditional. So I would focus more on what gives you the most control in your life. Because when you have the most control, you're going to be most at peace. So control is number one. Number two, really properly learn to look at the opportunity cost of something. And that's to say, like a really simple example, modern traditional financial planning would have you believe when you save money and then you use that money to invest in an IRA or some other investment in the S&P 500 that you don't have to account for, you used your original capital. The opportunity to gain off of that money or use that money is gone for you, your beneficiaries, your future generations. It's gone. That cost, that opportunity cost is never even talked about.
mm,
That is the opportunity cost. If you can think through how can I maximize across everything I'm doing instead of exchanging from one form of capital into another and into another to try and chase return, you're going to be head and shoulders ahead of your peers. So learning to really assess opportunity costs and learning to put a premium on flexibility and certainty, my goodness, your life is going to be so simple, regardless of what happens.
absolutely. Well said. And I'll leave it at that because this is where when you go down outside the details of it, how this sort of product in my life has certainly helped me and my family to get that peace. and level of certainty that I think most people want in some shape or form. So it's something that I'm so grateful to have in my life. And for those who are thinking about it, if this is intriguing, certainly reach out to Joe or myself or your local professional to learn more. Right, and this is not tax advice; this is investment advice. But hopefully, this was been an educational sort of explanation of this sort of tool and the tax code too. So Joe, I really appreciate your time. We're going to be having you come back on here for sure. You've got so much to share, and I really appreciate all, your time spending with me and explaining this to my audience here.
Yeah, Tom, thank you so much. I'd be happy to come back anytime. I appreciate
Awesome.
the opportunity.
Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.